welcome to this explainer. If you follow the financial markets at all, you know that stock buybacks get tossed around with some pretty highly charged political language. You know the drill. People arguing that companies are either responsibly returning cash or they're just manipulating earnings instead of investing in actual growth. Well, today, we're going to completely cut through that political noise. We're going to look strictly at the data and frame corporate buybacks as a rigorous mathematical capital allocation test. And this is especially crucial right now as we navigate a much higher rate environment in 2025.
Now, to really grasp why this matters right this second, just look at the sheer scale here. $1 trillion. According to S&P Dow Jones Indices projections for 2025, that is what S&P 500 buybacks are expected to approach for the full year. I mean, to put that into perspective, Q3 alone hit $249 billion. And what's absolutely fascinating is that this massive volume is happening despite the U.S. hitting net buybacks with a 1% excise tax. The scale here is undeniably huge, which means the stakes for us as investors, they are incredibly high.
Okay, let's dive into this. Today we're covering the buyback intuition, the systemic chain, high-rate era math, value creation versus destruction, the investor dashboard, and finally, critical red flags.
Section 1. The buyback intuition, first principles.
So here's the absolute simplest foundation, right? A buyback is just a capital return tool where a company exchanges its cash for its own equity. The quickest way to wrap your head around this intuition is that the company is essentially acquiring its own future cash flows. And look, just like literally any other investment, the price really matters. If a company buys its shares below intrinsic value, the remaining shareholders win. Your slice of the pie just got more valuable. But if management overpays for those shares, well, remaining shareholders lose value. It really is that simple.
And you can see how this stacks up against the other big tool for capital return, dividends. Buybacks absolutely exploded in popularity over the last decade, and that was mainly because of strong free cash flow and, crucially, structural flexibility. See, management can time their purchases, and they can easily just dial them back if times get a bit tough. Dividends, on the other hand, well, they run on a fixed schedule. They're generally taxed as regular income, and cutting them, yeah, that's basically a death sentence for a stock price. Buybacks basically give management a much-needed escape hatch.
Section 2. The systemic chain, the buyback engine.
Tracking a buyback requires a systemic approach. You can't just read a flashy headline announcement and call it a day. Step 1 is the funding leg. Like, where exactly is this cash coming from? Is it real free cash flow, or did they just take out new debt? Step 2 is the mechanism. How is management actually executing these purchases? And finally, step 3 is the asset outcome. What did this actually achieve? Did the total share count actually drop, or did something else happen? Tracking this exact flow of capital is totally non-negotiable.
Section 3. High-rate era math, the paradigm shift. And this brilliantly illustrates exactly how things have changed. Because the end of the zero-rate era totally broke the old rules. Back in the low-rate world, a company could borrow debt at, say, roughly 2%, and then use that cheap money to buy back stock offering a 5% earnings yield. The spread was positive, it looked financially rational, and it artificially boosted earnings per share. But wow, look at the high-rate math today. Borrowing costs might be sitting at 5 to 7%, while a stretched stock valuation might only give you a 4% free cash flow yield. That spread has completely inverted. A trade that literally looked like genius back in 2021 can absolutely destroy value in 2025.
The absolutely crucial point here is that cash-funded buybacks, using real excess free cash flow, those can still make perfect sense. But debt-funded buybacks, they face a massively higher hurdle today. The distinction between using genuine cash reserves versus issuing really expensive debt just to prop up the stock price, that is the ultimate test of management discipline in this new era.
Section 4. Value creation versus destruction, the formula.
So think of the return on a buyback kind of like this formula. It roughly equals the company's yield plus long-term growth minus the risk of overpaying. For a buyback to actually create value, 3 strict conditions have to be met. First, intrinsic value must be high, meaning the stock needs to be cheap. Second, it has to use excess cash, and by excess, I mean cash left over after funding maintenance, high-return growth projects, and R&D. And third, the balance sheet has got to remain strong. You just cannot compromise credit ratings or recession resilience just to buy back stock. But what about the value destroyers? Well, you can see the common failure modes right here. Buying at the very top of the market,
borrowing too much and losing your financial flexibility, masking dilution, which, hold that thought, we're going to talk about in just a second, starving R&D so the core business ends up suffering, and poor cyclicality. This last one is a brutal mistake where cyclical companies aggressively buy back stock at peak earnings when their pockets are full, instead of actually saving that cash to buy at trough conditions when the stock is, actually cheap.
And that leads us to the absolute worst version of a buyback. This is when a management team borrows at high interest rates to buy overvalued shares, all while the core business desperately needs reinvestment. Let me be perfectly clear about this. That is not capital return. That is financial engineering, plain and simple.
Section 5, the Investor Dashboard, Practical Application. Now, what's really interesting here is how we bring it all together into a practical framework.
Here is your comparative framework. Honestly, go ahead and take a screenshot of this because this is exactly how you read buybacks the right way. The best buyback analysis is always comparative. You need to look at the free cash flow yield to measure cash return potential. You've got to check net debt to EBITDA and interest coverage to ensure the balance sheet actually has the capacity for this. Look at the debt maturity wall. Is there some massive refinancing risk looming? And check the return on invested capital, or ROIC, to see if there are better internal investments they could be making. Remember, a buyback is only good relative to the other things a company could do with that exact same cash.
But listen, if you remember absolutely nothing else from this dashboard, please remember this single devastating question. Did the diluted share count actually fall? If a company spends $5 billion on buybacks, but the total number of shares outstanding doesn't actually drop, yeah, they aren't returning cash to outside investors. They are just neutralizing the dilution caused by handing out shares to their own employees.
Section 6, Critical Red Flags, Structural Warnings. Let's look at the absolute shutoff warnings. Red flag number 1 is exactly what we warned about earlier: buybacks funded by rising debt. In our current high-rate environment, if a company is increasing its leverage to buy back stock right as its debt maturity wall approaches, that is incredibly toxic. Refinancing that debt is going to cost them dearly down the road.
Red flag number 2, flat share counts, masking stock-based compensation, or SBC. If a company is heavily paying its executives and staff in stock, and then turning around and using its free cash flow just to buy back those same shares so the stock price doesn't drop, wow, that is a massive transfer of wealth to insiders. That is not a return of capital to you, the outside shareholder.
Red flag number 3, management targeting EPS compensation goals at peak margins. This one is a severe governance risk. If executives are aggressively buying back stock just to artificially boost their earnings per share so they can hit their own personal bonus metrics, well, they are completely ignoring the liquidity the business might actually need to survive the next recession.
To summarize the core thesis of this explainer, buybacks are not automatically good or bad. They create value when they are price-sensitive purchases of undervalued future cash flows using real excess cash. On the flip side, they destroy value when they are just debt-funded EPS engineering. We are living in a world where capital is no longer free. The math has completely changed.
So I'm going to leave you with this provocative thought as we wrap up today's explainer. Look closely at the companies in your own portfolio. Apply this framework we just talked about. Are the management teams that you are trusting with your hard-earned money actually returning capital to you? Or are they just engineering financial optics to survive a high-rate world? Thanks for joining me on this explainer, and keep digging into the data.